Hello and welcome to Econoday Unplugged. It's Tuesday, the 21st of May 2019, most notable in global capital markets, of course, for being the day before Mark Pender's birthday. In addition to Mark, I'm pleased to say that joining us this week is our Asian guru, Sydney-based Brian Jackson, and I'm Jeremy Hawkins here in London. Since we have Brian, let's start with some words of wisdom from the Southern Hemisphere. So, Brian, we've just had elections in Australia where not a great deal seems to have happened. But does that mean there's nothing new for financial markets to get excited about? Or is there more to it than that? And with regards to that, did the democracy sausage influence the result?
Well, I had a democracy sausage, yes. For those who don't know, there is a common practice in Australia when you go to the election booths. You have local groups or schools or sporting clubs having a barbecue, grilling a few sausages, and then you buy a sausage just before you go in to vote. So that's a very Australian way of exercising our democratic privileges.
Excellent.
So, but the thing about the election obviously was that nothing's changed. We've got the same government, but the surprise was that most of the polls and pundits were predicting that the opposition Labor Party would win. So we actually had quite a strong market response on Monday when the share market reopened. A lot of people had been factoring in some extra taxes on property and investment. So now that the Liberal Party, the incumbent government, has been returned, there was quite a positive response from the share market after that.
Jolly good. I noticed that you've had, your bond yields have been touching all-time lows again. Does that mean markets now looking for another RBA ease?
Yeah, I think that's definitely a very interesting story. We've had, over the last month now, more and more explicit signals from the RBA that a rate cut is on its way, and that's after nearly 3 years of no change in policy rates.
Right.
And all through last year, the message from the RBA was, the next move is probably going to be higher. So what's happened? Well, we've had inflation now for 3 quarters being below the RBA's target range of 2 to 3%. So they think, we might have to do something about that. And more recently, just in the last couple of months, we've also had some signs of the labour market coming a little bit slower. We've had the unemployment rate go up from 4.9% to 5.2%. So, we've had a change in conditions, and the RBA is saying, that means we might have to change the policy outlook. So at the meeting at the start of the month, they sent a signal in the statement. Then we had yesterday the minutes to that meeting providing more details about that discussion. And then after the meeting, we had the RBA Governor, Philip Lowe, come out and say, there's a lot going on. And at the next meeting in June, we will be considering a rate cut.
And has this got much to do with the slowdown in China?
I think that's definitely flowing through to it, but it's probably more domestic factors are driving it. As I said, the lower domestic inflation and some signs of cooling in the labour market, and also the property market. As you know, over the last 12 to 18 months, we have had housing prices come down quite a bit in Melbourne and Sydney, and that's just been another factor that's been weighing on household consumption. So, I think that's the main thing that they've been looking at. But, the situation in China is definitely contributing to, their more cautious assessment of the global outlook.
Okay, in terms of China then, I notice we had some comments coming out of Beijing suggesting that again this ongoing trade war, that it may mean that their stimulus will be stepped up to buttress the domestic economy. Do you think that's likely? And if so, what do you think that actually means?
I think that is likely. And because we're coming into this trade war with, a lot of the indicators already showing things are fairly soft in parts of the Chinese economy, particularly manufacturing. So to that respect, if we do have any further slowdown as a result of the trade war, they'll have to, I think, react. And we've already seen them announce back in March at the annual meetings of the National People's Congress that they would provide more fiscal support, and they would try and do a bit to ease liquidity conditions. So I think we'll see more of that. we had last week a whole bunch of data for the month of April. The month of March, showing a bit of a slowdown in some of the key indicators. Sorry, it was April. I'm losing track of where we are. But so we had retail sales and industrial production come off from levels, but in both of those cases, the officials did indicate that there were some sort of one-off factors that had contributed to that. So they, for the time being, they're sort of having a brave front saying, we're still doing okay. But again, that's all before any of this impact from the trade tensions is going to start flowing through to the data.
Yeah, sure.
Hey,
Okay.
Brian, this is Mark. I have a question about what's the feeling or the sentiment in Australia toward the U.S. Tariff actions? Do they think that they're punitive? Do they think that they're for everyone's good? Is there a view that's forming?
I don't think it's been really a huge factor from leading politicians or industry groups here. They haven't been very vocal about it, but I think in general, and that would also include the RBA in general, they are concerned about it, and in particular worried about the impact that will have on Chinese demand for Australian exports, obviously. So in general, I think the political class and the business class are pro free trade and don't like the idea of tariffs going up around the world. So that's not going to have a lot of support here, but they're kind of keeping their head down at the moment and sort of hoping that I'm sure there might be some things going on behind the scenes, but I think the hope is that both the Chinese and the Americans can come to some sort of agreement over time, and that there won't be a huge impact on world trade.
Okay, thanks for that, Brian. But before we just move on to Mark, perhaps just ask you quickly about Japan. I mean, expectations were for a fairly soft first quarter GDP, but in the end, we got a surprisingly strong headline print, but the components not that good?
Yeah, that's right. So, the key message there is that the headline number was boosted by basically a drop in import growth in the first 3 months of the year. So that obviously had an impact on the net trade number, which boosted the headline growth number. But if you strip that away, all the underlying demand components for the Japanese economy were actually softer. That includes household consumption, investment, and also public demand. So, yeah, the headline strength is quite misleading, and the actual demand for the economy is quite a bit weaker than it was the quarter before, and also exports were a bit weaker. So it's all about just that drop in imports that was boosting the number. All
right, and that's quickly on. If I'm right, they still have planned a hike in the sales tax in October. How likely is that it's going to take place now?
I think the government is still committed to going ahead with that. It's been in the pipeline for a long time now.
Yeah, right.
So I don't think at this stage that there's plans to pull that.
So does that mean the BOJ is going to have to try and offset it somehow with an easier policy?
They have come out and said, yeah, we stand ready to ease policy further if that's needed. Just in the last couple of months, that's been the key message in the BOJ statement that's coming out after their decision. So again, we've had this long period of policy stability in Japan, and for a long time there was expectations that they would be in a position to start moving policy back towards more normal levels. But it does appear that if anything, more stimulus will be needed, and that's sort of been a common theme across quite a few countries around here.
Right. Okay. Thanks a lot for that, Brian. Mr. Pender, talking of policy, you have minutes from the FOMC on Wednesday.
That's tomorrow.
Yeah, I noticed you had some slightly disappointing housing figures today. What's going on?
Well, it's the housing numbers are very volatile here, and if you smooth them out, they're not as weak as they look. We had a big jump at the beginning of the year. Mortgage rates are dropping very sharply, or have dropped very sharply here, and so that really has underpinned what are mostly better housing data, not just existing home sales that were today, which came in below expectations. But again, the trend is the best it's been in a while. Last year was a bad slump for the housing sector. But the data that really stand out here are the April data for industrial production, which showed a 0.5% decline at the headline level, and also for manufacturing. Manufacturing in this report, which measures volumes, has just been dismal all year. And then we also, last week, we had a retail sales report for April, which was really very surprisingly weak. Now, that could have calendar effects related to Easter, perhaps not. But it's been kind of a jigsaw or a sawtooth pattern for retail sales since the big collapse in December, and the consumer spending contribution from the first quarter fell in half or even more to the low 1% area. And the early expectations for the second estimate aren't improved any. And the first look at the second quarter was April was very weak. So it's interesting, Brian's talking about the, easier rates. And we haven't really, the last FOMC, which was May 1, Jerome Powell talked up a hawkish inflation line that really hadn't panned out. He cited unusual factors that were skewing core inflation lower, which is running at 1.6% at the last reading for March. He cited portfolio fees, which in the producer price report for April didn't show any improvement. Apparel sales, which in the CPI didn't show any improvement. Airline fares, which didn't show any subsequent data that you're looking at.
Seems to be a pattern here.
Yeah. So it's like, he obviously wasn't keyed in on what the advanced data was going to be. It was still being compiled, I'm sure. But in any case, a hawkish line is going to be more difficult to take, they're going to have to come up with a new spin. It'll be interesting to see in those minutes how strong that debate was, and if there is, a more, dovish underlying tone to FOMC policy than Jerome Powell was projecting in his press conference.
Interesting. I always ask you this, but what's sort of the early call on the current quarter GDP?
Well, it's not 1% at the low end, maybe 2.5% at the high end. As far as the consumer contribution, I think that is really not going to be very good. It probably may be in the 1% area again. Residential investment had fallen for 5 quarters in a row, and there was hope that there might be a bounce back there. Existing home sales aren't really a part of that data, but the new home sales are, and they showed a little bit of a boost, and starts have been improving. We might see a little bit of an uptick for residential investment. Capital goods, business investment has been solid. Whether it will continue to be so, I guess we'll have to see. Certainly, you wouldn't get that impression at all from the industrial production report, which is produced by the Federal Reserve, but it doesn't always fall in line with other data out of the factory sector. So. And the initial reaction in the data that we've been able to, the anecdotal data, whether it's, we saw something on the last week or two that would offer the earliest possible reaction to the China tariff breakdown. And we didn't see anything really negative, but there was one interesting thing that we saw was in the inflation expectations in the consumer sentiment report. Really, for that reading jumped, 0.3, something like that. And what's interesting about that gives you the idea of stagflation. It's like the tariffs are coming on, and all of a sudden, these consumer expectations, inflation expectations, which had been just sliding a little bit over the last year, all of a sudden jolt higher. And so that would be an interesting combination to a prospect that that would, it makes sense in a way, right? If you're going to get a decline in net global trade and you're going to get higher tariffs, you might have an inflation effect. So that's, I guess, the outlook isn't so great for the second quarter. I can say that.
Okay, interesting times the Fed, particularly if this stagflation scenario emerges. Okay, from my part of the world, let me round things off before we talk for too long. I'm going to mention, I suppose, the main focus as far as this week's concerned will be the upcoming European Parliament elections. They kick off on Thursday and will run through on Sunday when the bulk of the EU members will be voting. Normally, these tend to be ignored. Turnout typically is much more than 40% or so. And they tend to be ignored because invariably it's just a grand coalition between the centre-left and centre-right parties. So effectively, it's just steady as you go each time. This time round, though, it could have significant implications for the euro and indeed Eurozone financial markets, just because of some of the political swings we've already seen in various national elections over the course of the last year or so. Excuse me. So the worry is, I think, from the investor standpoint, that we do see a fairly good showing coming through from the anti-establishment or even anti-EU and nationalist parties, which, if that were to happen, that could really start to undermine some of the cohesion and the harmony we've had across European Parliament decision making over the course of the last 15, 20 years or so. Anything which really starts to undermine the perceived unity of a political framework across Europe has got to be bad news for the euro. And indeed, when we have the likes of the Italian government, where we already have this anti-establishment group in there already, making noises to the effect that they're more than happy to break the EU fiscal rules on borrowing if it's necessary to reduce their unemployment, that's going to get people really concerned about what's going to happen to the EU budget, which at the end of the day, the European Parliament is responsible for as we go forward. So keep an eye on these results because they could actually be very important. I should also say that with regards to that, at the moment, markets appear to be taking it pretty complacently. I already mentioned that Australia's got record low yields on its bonds, where we saw new lows being hit today in Spain and Portugal on their benchmark bonds as well. So it would suggest that markets aren't particularly worried. So it could be a shock around the corner there. Around off quickly with the UK and just the latest on Brexit. We saw talks between the government and the opposition Labour Party breaking down without any agreement at the back end of last week. So as things currently stand, the Prime Minister is planning to reintroduce for a fourth time her Brexit withdrawal bill. That will be in the week beginning the 2nd of June. It's widely expected still that it will be defeated heavily again. And if that is the case, the chances are that we will see a new Prime Minister in Downing Street within perhaps a couple of months or so. The worries for the for investor community is if we do see a new Prime Minister, then they're very likely to be much more, staunchly pro-Brexit than Theresa May is, who's always been something of a soft Brexiteer, if you like. So we've already seen the pound sliding on the back of such worries towards the back end of last week, and anything which suggests that we're going down that route would certainly put sterling under pressure. It's got to be said, of course, that Mrs May could still somehow draw a rabbit out of a hat and get both sides to agree on some kind of withdrawal bill. And indeed, again, going back to the European Parliament elections, that just might be the trigger. If we see a really poor showing by both the government and the Labour Party in those elections, it might force them to have to come out with some kind of compromise. And that would certainly be excellent news for sterling, which is another reason for watching these election results. Unlikely, certainly, but it is something which could actually happen.
Jeremy, what's the bias for the ECB right now?
The bias for the ECB at the moment is, I suppose you've got to say, is on the downside. And I say that because although ostensibly policy for the Eurozone is set between now and year end, effectively they've said that if things go according to plan, the current refi rate, which is still 0.0%, will still be at zero come the end of December 2019. However, in terms of the bias, they do come out with this assessment of economic risks. And as things currently stand, that's still biased on the downside. Now, okay, you can say that can move about a bit, which is perfectly true. But I suppose taken, as it literally stands at the moment, it does suggest they're more worried about economic weakness than they are about any kind of, renewed economic strength. And in terms of the economic figures, that does appear to work out quite well. The good first quarter was heavily front-end loaded into January and a bit of February. Most of the figures we've had for February and March have been disappointing, and the survey data for April so far, May coming up. Thursday we'll get the flash PMIs for May. That's pretty soft too. So if Europe at the moment does anything in terms of monetary policy, it's almost certainly, I think, going towards additional easing, certainly over the near term anyway. Okay, I guess that's quite a long global run through for today. So I guess we'll end it there. On behalf of Mark, Brian and myself, thanks as always for tuning in. Econoday Unplugged will be back as usual again next week. And I'm off now to find out how, for a fifth successive year, Australia managed to qualify for the Eurovision Song Contest. Who says globalisation isn't alive and well? Bye for now.